To get some insight into the stock sell-off that we're seeing, let's hear from Emil Wolter. He's head of regional equity strategy at RBS in Singapore. Emil, good to see you. I've got one question for you.
Morning.
Why now? What has unleashed this market panic?
I guess there's a number of different factors that are sort of coming together to produce a bit of a nosebleed reaction, but ultimately I would have thought that the lack of more concrete initiatives from the ECB yesterday is what kind of got the spirits boiling over, as it were.
Okay, how long does it continue?
It continues until we see a more robust policy response, I think. And the good news is we have the early beginnings, as I think I discussed on your channel yesterday. So, you know, the Bank of Japan has re-engaged and increased their asset purchase programs. The ECB did start to buy bonds yesterday, but clearly on nowhere near the scale required. And then, of course, the Fed will anyway meet in Jackson Hole in about 2 weeks' time, but might well be compelled to come forward before that if things continue to move the way they are.
It doesn't appear that QE2 works, so why go to QE3? I mean, isn't this exasperation on the part of investors because governments around the world don't have any ammunition left, including central banks?
Well, in fact, central banks have got unlimited ammunition because they have the ability to print money. Now, I would say that QE2 has worked to the extent that it's helped asset prices go higher, right? If you look at share prices, if you look at bond prices, if you look at commodity prices, all of that are higher. Now, there's a fair point with regards to the real economy, but perhaps Ben Bernanke will just say that's because we didn't do enough of it.
Right. I wonder if you are brave enough to step in at this stage and buy stocks. We've got strategists saying that you're still going to see a rise in the S&P 500, some 17% between now and the end of the year.
I think the key is to be selective. You know, basically there are parts of the market which don't look that attractive here, and we've been saying actually that for a while. Things like commodities we haven't been interested in for quite a while, and we issued a very bearish note at the end of March. I think there are other parts of the market, particularly those in Asia, that are related to Europe, companies with substantial sales and assets in that part of the world we wouldn't really buy at this point. There's also good things going on. So the telco space looks excellent. I think there's increasing value in technology, and we have a good domestic story unfolding itself in a number of economies out here, which gives us good upside in banks. So actually, I'd be quite happy to nibble away at the market here. We're about 10% undervalued at current prices. We might become a bit cheaper over the next 2 weeks, but then I think we'll bounce back quite sharply.
But developed markets, are they a no-go zone?
No, I think depending on where you are. Again, there are sectors and areas of developed markets that you might want to touch. And then there's clearly areas where you want to be extremely cautious. I'm not an expert on neither Europe or the US or indeed Japan, but I mean, if Japan is going to be very serious about intervening and trying to push down their currency, that is probably going to increase the domestic liquidity conditions. And the stock market cannot be said to be expensive, so perhaps that will mean relative performance for Japan could look quite good as well. How
different is the kind of panic that we're seeing now to that of 2008, of the financial crisis, of the credit market seizing up? Do we potentially face another moment like that in the global economy?
I think the risks are certainly there, and they're all coming from your part of the world, to be honest. I mean, Europe has got the ingredients to create a systemic financial crisis amongst the lines of what we saw in late 2008. You know, basically, if we find that the European banking system seizes up and it impacts the US banking system, then obviously that would be more than enough to create a global scramble for cash. I don't think that's quite where we are today, but the politicians and the central bankers need to be aware of this, and they are, but now they need to act.
But we know that there isn't a whole lot of agreement across the board amongst European politicians or amongst American politicians, for that matter. The U.S. soft patch, the developed market soft patch, looks like a bit more now, doesn't it?
Which is why we might see a bit more downside in markets for the coming weeks or so. But ultimately, I think everyone's memories are reasonably fresh when it comes back to where we were just a 3 years ago, and I would have thought most people would be keen to avoid a repeat. So, yeah, I think it's fair to discuss whether or not quantitative easing works as a policy. I think the reality is they're going to have another go.
Emil Wolter
and that should
from
be,
RBS.
good for equities.
All right, we will leave it there. Thank you so much for your insight. Really appreciate it.